What does it mean to present fairly? The financial statements must be presented fairly. The auditor's job is to ensure they are presented fairly. Technically speaking, that means they are in accordance with a generally accepted framework. In the US, that is GAAP. Internationally, that's IFRS. In order for an auditor to test this, they are going to assess whether management's claims are true. Management's claims are called assertions. We try and categorize the assertions according to the financial statements. For the income statement, we look at the transaction assertions. This captures what happened during the period. We then look to the balance sheet to see if the account balances are correct. In your 2303 class, we may have thought of the income statement as like a video of what happened in the year. So you can see the progress that was made, where the balance sheet was more of a snapshot. The third type is presentations and disclosure. These represents the notes that accompany the financial statements. Generally speaking, we will not spend a considerable amount of time on those. The first major assertion is the completeness assertion. It ensures that everything that happened in the real world or in the economic world actually makes it into the accounting records. We're most concerned that management includes items they might not want to include, for example, liabilities or expenses. Management would have strong incentives to omit these. Other circumstances where you would see completeness violated is if a transaction isn't recorded or is recorded too late to be included in the current year's financial statements. The corollary to completeness is existence. It's making sure everything that's in the accounting records actually happened in the real world. Existence refers to items on the balance sheet. It is very similar to occurrence, which relates to the income statement. These terms are often used interchangeably. One would say something, a transaction violated the existence assertion if it didn't happen. So, for example, fictitious revenue or accidentally including a transaction twice would violate the existence assertion. Related to the completeness and existence assertion is the cutoff assertion. This assertion assumes the management did not include the transaction in the correct period. As you can see on the timeline, there is a window each year where we're supposed to include all the transactions after the first day of the year all the way to the end, but nothing before or after this window. So if something did not exist at fiscal year end, and either because it occurred too early or too late, it would not be included either as a transaction or as part of our snapshot at the end of the balance. But everything in the middle must be included. The classification assertion makes sure that we take the economic reality and correctly put it into the accounting records. There's going to be times when it's hard to know where exactly certain items go. It's important for the auditor to include them in the correct bucket or account. For example, we would need to include sales transactions as accounts receivable if it's not interest-bearing, but notes receivable if it is interest-bearing. We would also want to make sure we classify expenses correctly. It's very important to do classification correctly because it can influence how the financial ratios are determined and how analysts perceive the company. The valuation assertion, sometimes called accuracy, relates to making sure we take the correct economic value and we correspond it to the accounting value. A common area where you'll see this assertion come up is in estimates, where there's judgment. For example, the allowance for doubtful debts is a matter of assessment. To make sure it's correctly valued, we need to look at what factors influence it. So even if management includes an allowance for doubtful debts, that doesn't necessarily mean it's correct. Valuation tends to be less of a challenge with an objective sale or a purchase because there is no question on the value of the item because there's clear documentation to support it. The authorization assertion oftentimes relates to the occurrence assertion to make sure a transaction was properly authorized. It links to the internal control function. Did it happen? Should it have happened? Become the questions. Whether a transaction is included in the financial statements may depend upon whether it was authorized. It may also influence our allowance for doubtful debts and other accounts. Rights and obligations is another technical account that we need to pay attention to. It deals with a lot of technical issues. For example, leases. Should an item be classified as an expense or an asset? You'll also see it relate to goods on consignment. If goods are on consignment, then they're not sold, and we would need to make sure we maintain as ownership. To help memorize the assertions, people have used over the years mnemonics. Mnemonics are simple ways to remember things. For example, aka cover summarizes all the assertions. You also have the alternative to memorize smaller ones. For example, the balance assertions can be known for crave. As seen on the screen, that would represent completeness, rights and obligations, allocation, valuation, and existence. Mnemonics are great little tools to help you memorize early in your career. You would still need to know what each of these mean. For transactions, CACO is another tool you can use. Before we move on, there is a few things we want to make sure we know about the assertions. First, the assertions is not a one-to-one relationship. Oftentimes when we're doing tests, we're not going to be looking for just one assertion. We'll be doing procedures that will tell us both about whether a transaction occurred and whether it's properly valued. So we can get a lot of synergy from our testing. We also know that the assertions relate to earnings management issue. Understanding what motivates management, what influences their judgment, will help us understand what assertions are most at risk. The assertions vary in importance, and they vary by account. For example, with revenue, we would be more concerned about the existence of revenue than completeness. Likewise, with expenses, we'd be more worried about completeness than occurrence. Finally, there are some items like consignment and leases that we've talked about that we need to pay particular attention to. As we move forward in the course, we're going to be looking at the assertions as a driving factor in our decisions. All our audit tests will ultimately relate to the assertions. Have a great day.